On August 15, 1971, President Richard Nixon severed the final thread connecting the United States dollar to physical gold. The decision was presented as temporary, a brief pause to defend American interests against currency speculators. That pause never ended. What followed was not chaos, but something far more unsettling. A redesign of the entire global financial architecture built on a premise that had never been tested at scale across multiple generations. The premise was simple. Trust could replace scarcity, confidence could substitute for constraint, and the entity responsible for maintaining that confidence would be the same entity with the greatest incentive to expand supply without limit. This was not the first time a major power had attempted such an experiment. History is littered with the remains of currencies that began as stores of value and ended as mechanisms of wealth transfer. The Roman Empire debased its silver denarius over 3 centuries, reducing its silver content from nearly pure to less than 5% by the time of Emperor Diocletian. The process was gradual, methodical, and justified at every stage by immediate necessity: military expenses, grain subsidies, administrative costs. Each debasement solved a short-term problem while quietly eroding the foundation of long-term stability. Citizens adjusted, prices rose, and the cycle repeated until the currency itself became a unit of measurement for decline rather than prosperity. In 18th century France, the economist John Law convinced the regent Philippe d'Orléans that paper currency backed by future colonial revenues could stimulate economic growth without the constraints of metallic money. The Mississippi Company scheme that followed created a speculative frenzy, briefly making France appear wealthier than it had ever been. Within 3 years, the entire structure collapsed. The currency became worthless, trust in government-backed financial instruments evaporated, and France's path toward fiscal crisis and revolution became nearly inevitable. The pattern was identical: initial success, growing confidence, expanding issuance, and eventual repudiation. What makes the modern system distinct is not that it operates differently, but that it operates on a scale and with a sophistication that earlier experiments could never achieve. The mechanisms are no longer visible debasement or overt printing. They are balance sheet expansions, quantitative easing programs, repo operations, and currency swap lines. The vocabulary has changed, but the underlying dynamics remain constant. When a central bank purchases government debt with newly created reserves, it is performing the same function as a Roman mint reducing silver content. The difference is speed, complexity, and the ability to obscure the process behind technical language that discourages scrutiny. The Bretton Woods system, which Nixon dissolved, was itself an acknowledgement that purely discretionary currency management had failed. After World War I, European nations abandoned gold convertibility to finance wartime expenditures. The result was not immediate disaster, but a slow unraveling. Weimar Germany's hyperinflation is often cited as an extreme case, but it was only the most visible manifestation of a broader pattern. France, Italy, and Britain all experienced currency instability, capital flight, and political upheaval rooted in the loss of monetary constraints. By 1944, when delegates gathered in New Hampshire to design a new system, the lesson seemed clear. Currency stability required an anchor outside the control of any single government. That anchor lasted 27 years. When it was removed, the justification was pragmatic. The United States was running persistent trade deficits, foreign central banks were accumulating dollars and demanding gold conversion, and the domestic economy was straining under the costs of Vietnam and Great Society programs. Maintaining convertibility would have required either fiscal discipline or economic contraction, both politically unacceptable. So the anchor was cut, and the system drifted into uncharted territory. What followed was not immediate collapse, but a recalibration. Oil-producing nations agreed to price their exports in dollars, creating structural demand for the currency, even without gold backing. This arrangement, formalized through a series of agreements with Saudi Arabia and other OPEC members, gave the dollar a new foundation: global energy transactions. As long as oil remained the primary energy source and was priced exclusively in dollars, foreign governments had no choice but to hold dollar reserves. The system worked, but it introduced a new dependency. American monetary policy now affected not just domestic conditions, but the entire global economy. Throughout the 1980s and 1990s, this arrangement appeared stable. Inflation was brought under control, financial markets expanded, and the United States emerged from the Cold War as the sole superpower. The dollar's dominance seemed not just secure, but permanent. Central banks around the world accumulated dollar reserves, and any suggestion that the system might be vulnerable was dismissed as conspiracy thinking or financial pessimism. The belief took hold that modern central banking had transcended the limitations that destroyed earlier monetary experiments. Sophisticated models, independent institutions, and real-time data could prevent the mistakes of the past. The 2008 financial crisis tested that belief. When major financial institutions faced insolvency, central banks responded with interventions that would have been unthinkable a generation earlier. The Federal Reserve's balance sheet expanded from less than $1 trillion to over $4 trillion within 5 years. The European Central Bank, Bank of Japan, and Bank of England followed similar paths. The justification was consistent across jurisdictions. Preventing systemic collapse required extraordinary measures. These measures were described as temporary, emergency responses that would be unwound once stability returned. The unwinding never came. Instead, each attempt to reduce balance sheets or raise interest rates triggered market disruptions severe enough to force reversals. By 2020, when a global pandemic provided new justification for intervention, central banks abandoned even the pretense of normalization. Balance sheets expanded again, this time accompanied by direct fiscal transfers on a scale that blurred the distinction between monetary and fiscal policy. Governments issued debt, central banks purchased that debt, and the proceeds were distributed to citizens and corporations as grants, loans, and subsidies. This is the mechanism that most analyses miss. The system is not designed around sustainability. It is designed around crisis management. Each crisis justifies interventions that become the baseline for the next cycle. What was extraordinary in 2008 became routine by 2020. What was routine in 2020 will become insufficient in the next disruption. The ratchet moves in only one direction, and each turn makes reversal more difficult and more painful. History suggests that this pattern does not end through deliberate reform. It ends when external forces impose constraints that political systems refuse to impose on themselves. For Rome, that constraint came through military collapse and territorial fragmentation. For France, it came through revolution. For Weimar Germany, it came through political radicalization and war. The specific mechanism varies, but the underlying dynamic is constant. Systems that rely on expanding claims against future productivity eventually encounter limits, and those limits are discovered not through careful planning, but through sudden stops. The question facing the current system is not whether those limits exist, but when they will be encountered and what form the adjustment will take. Some analysts point to rising gold prices as an early warning signal, the indication that portions of the global financial system are beginning to price in currency instability. Central banks in China, Russia, and other nations have been accumulating physical gold at rates not seen since the 1970s. This behavior does not necessarily signal imminent collapse, but it does suggest that confidence in the existing arrangement is no longer universal. Taiwan's role in this context is more significant than casual observers recognize. The island is not just a geopolitical flashpoint or a semiconductor manufacturing hub. It sits at the intersection of multiple supply chains that underpin global industrial production. Any disruption to flows through that region would cascade through systems far removed from the immediate geography. Metals trading groups operating out of Taiwan are not making procurement decisions based on quarterly earnings. They are positioning for scenarios where supply reliability matters more than price optimization. When industrial buyers begin prioritizing security of supply over cost efficiency, it signals a shift in how risk is being assessed at the institutional level. This connects back to the resource story unfolding in the Golden Triangle. The region has geological potential that has been understood for decades, but potential alone does not create production. What converts potential into reality is a convergence of factors: capital availability, commodity prices, buyer relationships, infrastructure access, and regulatory clarity. When these factors align, projects that appeared marginal suddenly become viable. The timeline being discussed around 2028 production is not arbitrary. It reflects a calculated assessment of how long it takes to move from resource definition to cash flow under favorable conditions. The operational details matter because they reveal whether a company understands the constraints it faces. Direct shipping strategies are not universal solutions, but in specific circumstances, they can compress timelines and reduce capital requirements enough to change project economics. The chemistry of the ore, specifically its low sulfur and low arsenic content, creates blending value that goes beyond simple metal content. Buyers who specialize in optimizing mixed feeds can pay premiums for materials that improve overall processing efficiency. This is not speculation. It is how industrial supply chains function when penalty structures create economic incentives for cleaner inputs. What separates this narrative from typical mining promotion is the emphasis on measurable progress rather than hypothetical outcomes. Bulk sample results that exceed expectations provide validation that theoretical models do not. Signed contracts with identified buyers eliminate the ambiguity around whether a market exists. Proximity to existing infrastructure reduces the binary risk inherent in isolated projects. None of these factors guarantee success, but they shift probabilities in ways that institutional capital can model and price. The broader pattern here is that hard assets are being revalued not because of enthusiasm, but because of concern. When central banks expand balance sheets indefinitely, when fiscal deficits become structural rather than cyclical, when currency stability depends on perpetual confidence rather than tangible constraints, Intelligent capital begins searching for alternatives. Gold, silver, and other physical commodities represent claims that cannot be inflated away through policy decisions. Production capacity for these materials represents future cash flows denominated in whatever currency environment emerges. History does not repeat precisely, but it rhymes with uncomfortable consistency. Empires that believe their currency dominance is permanent discover that dominance is conditional. Systems that rely on trust without verification eventually face verification without trust. The timeline is always longer than pessimists expect and shorter than optimists assume. What appears stable can remain stable until suddenly it is not, and the transition is rarely gradual. The current system has lasted 53 years since the gold link was severed. Whether it lasts another 53 or 5 depends on variables that are accumulating outside the view of most participants. The signals are present for those willing to look beyond narratives and examine the mechanisms underneath.